Hi, my name is Larry Walters, and this video is part of the Leveraging Land-Based Finance for Local Governments, produced by Global Land Tool Network and UN Habitat. Now there's a special note related to this particular topic that we're going to talk about, which is the annual recurring tax on land and property. This is a topic that is complex, and there are many parts to it. This particular tax is widely used around the world, not very effectively in many instances. So we want to talk about two different aspects, and so we've divided this video into two parts. And you'll see in the training materials there's actually two different modules. Module 1 is land and property tax policy, and that's what this first part will deal with. In part 2, we'll cover land and property tax administration and the administrative aspects of the tax and the challenges associated with it. But in part 1, we want to talk about the policy choices and design. We'll introduce the topic, and we'll talk about cases, and then you can discuss the policy issues in your small and large groups. Okay? The objectives in this session are to familiarize participants with the key issues and principles that should be considered in designing, reforming, or administering policies that govern the annual tax on immovable property. And we also want to help participants understand and articulate the key tasks that must be performed in order to design or reform an annual tax on immovable property that is likely to be fair, efficient, and productive. Again, we're focused in this session on tax policy design. The next session will talk about administration. Definition and purpose. The recurring tax on property is most commonly an annual tax levied on land, improvements such as buildings, or both. There are three purposes for the tax. The first is to establish an ongoing revenue stream for local needs. It also provides a mechanism for charging residents and businesses for the services that are not subject to user charges. And finally, it provides communities with a mechanism for sharing in the increased private land values that are created from public actions. Let me distinguish between the recurring tax on land value and the recurring tax on building value. The recurring land value is a tax based on the value of the land or on its attributes. It's assessed annually. It can be collected in installments. It falls on either the landowner or on the occupant, either one. In some cases, it falls on both. The recurring tax on buildings is estimated based upon the value of the permanent improvements or on their attributes. It's assessed annually. It can be collected in installments. It either falls on either the landowner or on the occupant or both. Okay. Minimum requirements. You need an appropriate enabling legal framework for both. You need a fiscal cadastre, which is a land registry that includes all of the taxable land plots. You need an appropriate estimate of taxable value. You need the administrative ability to calculate the tax due, to deliver the bills, and collect the tax. So let me talk about some foundational principles, because taxes on immovable property, land and or improvements, lie on four different foundation principles. Okay? The first one is property rights. The property tax system, and I'm going to talk about the property tax system, but when I say that, I mean both the land and the property. Okay? The property tax system should reflect and be sensitive to the institutions and traditions related to land and property rights. This is an important issue. And there are two schools of thought on this, and both of them are quite common internationally. From one perspective, land and property is simply an economic commodity. It can be bought, it can be sold, and just like any other economic commodity. From the other perspective, land is fundamental to the achievement of human rights. And as such, it is different from, it's not really a straight economic concept. Now, you can design an effective property tax, land and property tax system from either perspective, but it matters which of those perspectives you have in how you design it. You can't take a system that's designed to treat economic concepts and apply it if it's a social rights issue. And that you have to be sensitive to how those changes happen. Again, we can do an effective system in either context, but the design looks a bit different. Okay? The second foundation principle is how those property rights are registered. The property tax system has to reflect the realities of the current formal and informal land right holdings. If you have a complete registration system, all the land is entered in, you can approach the system from one way. In many cases, though, it's very incomplete. That doesn't mean you can't do it. You can't have an effective land and property tax system, but it means that your system has to acknowledge the imperfections of your land registration system and adapt. Okay? The third foundational principle is real estate markets. The option that's selected should depend on the extent and maturity of real estate markets. And this is often a mistake that has been made in the past, to take a system that works well in an area that has mature real estate markets and apply it in an area where markets don't exist at all, or they're not very mature, they're not very complete, is a prescription for failure. Again, we can put in place a system that will work if the real estate markets are not mature or effective. We just need to acknowledge that that's the case and design the system appropriately for that context. And the fourth foundation principle is the administrative capacity. Local governments must have the capacity to administer whatever system we design. And so we have to be sensitive to what their capacities are, what their expertise is, and where that expertise resides in the various government agencies. Those are the four foundation principles. The land and property tax system rests on those four principles. If we're going to get it right, we have to pay attention to those four concepts. Legal framework. The legal framework has to define and lay out a variety of elements in this system. It has to define what's taxable. Is it the land? Is it the buildings? Is it both? Is it some land but not other land? It has to define what's taxable. It has to define what constitutes an improvement, if improvements are subject to the tax. It has to define what is meant by taxable value. Is it the market value? Is it the size? Is it the location? What are the attributes that go into defining the taxable value? It has to identify who's responsible for paying the tax. Now, it's often the case that it's the owner. But if the owner can't be found, then what? In other cases, it's the occupant. And if it's an owner, but we have the ability to tax the occupant and then expect the occupant to recover the money from the owner, that works too. In the case of France, they have one tax on the land, they have a different tax on the occupant, and if it's an owner-occupied property, they get the privilege of paying both. Okay? So it's all a question of how we're going to design the system, bearing in mind those four principles that we talked about. Next, we have to determine the process for setting the property tax rate. Who's going to set the rates and how often? Is that set by a central agency? Is it set by a local government? How much flexibility does the local government have in setting the final rate, if any? All of that needs to be laid out in the legal framework. We have to assign the administrative functions to appropriate agencies. Who is it that's going to be maintaining the property registry, the list of potential taxpayers? Who is it that's going to be producing calculating the taxable value, calculating the tax obligation, producing the bills, delivering the bills? Who has responsibility to collect? Who has responsibility to follow up? And what are their rights and opportunities for people who are trying to avoid the tax? And finally, the legal framework has to assign the tax revenue. Who's going to get the money? Is it the local government? Is it the central government? Is it divided between the two? Does part of it go to fund the registration system? Part of it go to fund the valuation system? How all of that gets worked out needs to be laid out in the legal framework. Defining the base. There are two options for defining the base for a land and property tax. On one hand, there is the market value approach. On the other hand, there is the land and property attributes approach. With a market value approach, we generally talk about the cost of buying the land and constructing the building. That's the cost approach. We talk about a comparable sales approach. What do similar properties actually sell for? We talk about an income approach. If it's an income producing property, how much income does it generate? All of these factors are issues that the market pays attention to in setting the value of a property. And we can use that information to estimate the value of this property for property tax purposes. Another approach to market value is the annual rental value. And this is an approach that's used in the United Kingdom and other parts of the world that have had some historical connection to the United Kingdom. On the other hand, well, that market approach takes a lot of information. It takes a lot of data. If we don't have it, we can use the actual physical attributes of the property to determine what its marketable value is. From the simplest perspective, you can just have a flat rate. Oh, you have a property, this is how much tax you owe. That isn't very fair, so we tend to say, okay, let's use the land and building area and location to make, just use the size of those things to determine and where they're located. We can also use value banding. If the value of your property is anywhere within this range, you're going to pay this much tax. If it's a little lower range, you're going to pay less tax. Higher range, that's used for residential properties in the United Kingdom. Again, there are some concerns about the fairness of that system, but it works. Another approach is what I call the cadastral value approach, where we're using market indicators to determine average relationships between property attributes and value generally in a very broad sense. Not to the extent that we use that information in the market approach, but it approaches the market approach. And you can start over here with the system that looks at property attributes, and as the data becomes available, as the system becomes more sophisticated, you can move to a market value approach if you wish, but you don't have to. There are many parts of the world that have a very effective property tax system based upon the attributes of the property. Okay. What do you use for a valuation standard? There are two choices here: highest and best use versus current use. And here we have to think particularly about the issue of agricultural land at the urban fringe. If that agricultural land is viewed as agricultural property, as agricultural production value, may be relatively modest. But if we think about, oh no, we're going to convert that to an urban use, then all of a sudden that value, the land of that value goes up dramatically. And so thinking about, do we wish to preserve agricultural land, in which case we'll continue to value that land as agricultural land, or do we wish to encourage its conversion to an urban use, in which case we'll tax it at its market value. There's also this issue of capital market versus rental market. Capital markets tend to look at the highest and best use. Rental markets tend to look at the current use. So the issue of the valuation standard that we want to use really comes down to, are we talking highest and best, or are we talking current use? Also a question of how often are we going to revalue? Whatever the system is that you're going to use to value property, it has to be revisited periodically. You can't go 50 years and not revalue the property and maintain a system that is fair. It has to be updated more frequently than that. Generally on the order of every 5 years or so. You can stretch it out to 10 in some circumstances, but what you're going to find if you do that is what we call sticker shock. That the change in value for particular properties is going to be so dramatic that taxpayers will get very, very unhappy. Whereas if you can revalue on a regular basis, the changes are much smaller and they're much easier for people to understand and absorb. Okay? So who will set the tax rate? Is that going to be a central authority or a local government? The advantage of having a central authority do it is it's uniform everywhere. Everybody's paying the same tax rate. You don't have competition between local governments trying to drive the tax as low as possible to attract businesses or development. The advantage of having local government do it is they understand their needs, and not all local governments have the same needs. And so a local government may say, you know, we want to invest more in our schools, and so we're willing to tax ourselves more heavily to achieve that goal. Let us do that. Generally speaking, the best approach is to have the central authority establish a range of values. Here's the highest, here's the lowest. Anywhere in that range, the local government can set the final rate. That's generally the best approach to take. How many rates will there be? Well, here there's great virtue in simplicity. It's possible to say, well, we have a large industrial plant, they should be taxed at one rate. We have a shopping mall, they should be taxed at a different rate. We have the small mom and pop store down on the corner, they should be taxed at a different rate. And then we have these residents, they should be taxed at a different rate. It's quite possible to articulate what we call land use classifications that would each have a different rate. There would be a different rate applied to property in each of those classifications. But as soon as you do that, you've increased the administrative complexity of the system dramatically. It's much harder for local officials who then have to come in and say, all right, this property has an apartment on top, it has a storefront on the bottom. Is it residential? Is it commercial? What kind of commercial is it? There's more opportunity for error, there's more opportunity for abuse if you have lots of classifications. There's great value in keeping it very simple and simply saying, okay, here's the value of the property, there's one tax rate that applies to all of the property, much easier to administer, much fewer chances for errors and abuse of any sort. So let's talk about cases so that you can see how some of these principles play out. The first case is the reforming the current land and property tax in Albania. Albania had a tax on land outside the urban area, no tax on land inside the urban area. They had a tax on buildings in the urban area, but it was seriously outdated. And so in this case, you'll see the efforts that they went through to understand the nature of the problem and to consider alternatives for changing their policies on how to think about land and property tax. Singapore is another interesting case because in Singapore they had an objective of saying, wait, we have poor people, we have very, very wealthy people, they ought not to be paying the same tax rate. And so they're trying to use a progressive tax rate so that people in relatively low value property pay one tax rate, people in a higher value property pay a different tax rate. The other thing about Singapore is it's based on the annual rental value. The Albania case, it's based upon the capital market value. So you can see how those two countries implement the policies and in an attempt to achieve their objectives. With that, that's the end of our discussion on policy, but a couple of final thoughts on this. I want you to think about the similarities and differences in the two cases and what they suggest about the essential tasks in setting the policies for the recurring tax on land. In both of the cases, you'll see that raising the revenue was not the only policy objective. But I want you to recognize also that pursuing social objectives through the annual tax on land is both difficult and very imprecise. We tend to know a lot about the land and the building. We know virtually nothing about the people inside the building if you're a local tax administrator. Okay? And because you lack that knowledge and understanding of their situation, it's difficult to tailor your policies to address the needs of the individuals with any kind of precision just through the land and property tax. Second point that I think you need to recognize is that local history is extremely important. How it's been done in the past creates some expectations about how things should be working now. You can't ignore that. That has to be factored in. Third point is that building on existing policies and administrative capacities is critical for success. Recognize start where you are and try to make progress. The ability to adopt meaningful land tax policies is not independent of other governance capacities, such as the judicial system, the mail delivery system, the functioning land markets. All of these things interact. Remember those four foundation principles. How they interact will drive how we design the policies for our system. You should only add policies that increase administrative complexity when the system is working reasonably well and you have the capacity to effectively implement those new policies. With that, that's the end of part one. Enjoy your discussion.